So we have just learned what is money, right? And then so we learn what is money aggregate. And then the last question we were trying to understand is, so where does those money aggregate coming from? So if we only have a small fraction of the money, so if only a small fraction of money supply exists as currency in circulation, the answer to that is the bank in the modern economy, they can generate money. Now let's see so how bank can generate money. But first, what we learned is so the bank essentially works as a financial intermediaries. They bridge the gap between buyers and sellers, or it works as intermediaries between whoever has liquid assets and who need money or who needs resource to finance the illiquid investment, right? So here, so we can use this T account to explain how money, so how bank works, or what's the business model for bank. And from here, we also will understand how bank can create money. Okay, so this account actually is called T account. It's looked like T, right? On the left hand side, we have assets. On the right hand side, we have liability. Okay, so start with liability. So liability includes deposit. So essentially, the savers put their money in the bank. Okay, and it is a liability in the sense, so whenever the savers knock the door of the bank, so the bank is obliged to pay the amount the saver want to withdraw. So it is a liability. Now with this saving, what the bank can do, so they can make investment, not go to the asset side. So usually they can make loans, right? So make loans and then they can earn interest. In reality, usually the loan interest rate, meaning the lending rate, is higher than the saving rate. So that's how the bank makes money. Now you may wondering what is reserve. So reserve, it just means the bank usually need leave aside a fraction of the deposit they have, just in case the saver come to knock their door and they want to withdraw, right? So the reserve usually either just save in the bank, or but in modern days, so this reserve will be put in central bank's account, right? So we will come back to that later. But just look at here, that's the simplest possible account for a bank. So the bank attract deposit, and then so they use the deposit to finance those illiquid investment projects. So just show up as loan. And furthermore, so the bank may leave aside a fraction of those deposits just in case the savers need withdraw cash, right? Okay, so here are those explanations. So this T account is a tool for analyzing a business financial position by showing the business assets and the liability. And the bank reserve is the currency that banks hold in their vault plus their deposit at the Federal Reserve. Federal Reserve here is the central bank. Okay, but in either case, both was used to dealing with the potential case the savers want to withdraw cash from the bank. The reserve ratio, which is a fraction of bank deposit that a bank holds as a reserve, in this case, is use 100,000 divided by 1 million, which is 10%. Okay, and certainly, so the smaller the reserve ratio, meaning the bank can make a larger loan, right? But that becomes more risky. If the reserve ratio goes to zero, meaning the bank can potentially lend out all of their deposit to borrowers, and that becomes very risky. That means whenever there's someone come to the bank want to withdraw cash, So the bank has nothing to pay the savers. Okay, so in that sense, zero is not a good idea. On the other hand, if the reserve ratio goes to 100%, the bank is not going to make any profit. Why? Look at here. So if the reserve ratio goes to 100%, meaning for each penny the bank attract as a deposit, they must leave aside, just put in their vault or put at the Federal Reserve. Okay, so essentially they're going to make no profit, right? So then in reality, so this reserve ratio is between 0 and 100%. Okay, and also, so the reserve ratio is a tool or important tools the central bank use to regulate the financial market. All right, to summarize, the primary purpose of financial market and the institutions, particularly bank, is to act as a bridge between lender and the borrowers. But throughout this process, the bank is going to create money. Right? Now, I'm going to skip the following few slides. So this just I will come back to this later. Now, instead, I'm going to show you how the bank is going to create money. By understanding how bank can create money, we are going to understand the potential problem in the financial system. And then we will go back to those slides again to see why there exist such regulations in reality. Okay, now let's use this example to understand how bank creates money. Okay, where we start? We are going to start with someone in the economy who has some cash and who want to save for future, meaning so he or she at the moment doesn't want to use those cash. Right? In old days, so what he or she can do just probably is keep the cash in the shoebox, okay, and put in a safe place in the house. But in modern days, what he can do, he can deposit the cash at a bank. But then some students say, okay, so he can open a Robinhood account and then so use the cash to invest. Fine, so but that's next step. But first, we need to understand how things is going to moving around with bank, right? So this Robinhood or this stock market investing, that's more advanced stage. Let's just start with the basic with the bank. All right. So start with this individual has $1,000 cash. If he did not deposit the cash at the bank, and then the money aggregate will be 1,000. And actually the money aggregate will show up as currency in circulation, which is the currencies he has, or the cash he has, which is 1,000. Right? So now let's see what happens if he put this 1,000 in the bank. Okay. Now, the bank is going to have an account for this individual. And then this individual has a checkable deposit of 1,000. And this cash is going to disappear. Right? And so, but for the bank, so this checkable deposit becomes a liability. Why is it a liability? Because essentially this is Silas. So he has the right to withdraw his money from the bank. Right? Okay, so now if we have a reserve ratio of 100%, and then so the bank must keep all of this 1,000 either in their own vault, or so they just put this $1,000 at the safe place at the central bank, which is Federal Reserve. Now in that case, so the money aggregate will stay at 1,000. Why is that? is because this cash disappear, right? So the deposit is 1,000, but that's all, right? So we only have 1,000 in the financial market. Okay, but there's no new loans. Okay, so now we have 1,000 versus 1,000. So this is initial step. But certainly the bank will not exist if the reserve ratio is 100%, right? But in reality, what happens is, so usually, so the reserve ratio is smaller, right? Let's say, for example, the reserve ratio is 10%, as we saw earlier. What that means? That means the bank can make some loan, and the loan they can make will be 900, because now they must leave $100 as a reserve, right? Because we just say there's a 10% of reserve ratio. Okay. Now let's calculate the money aggregate again. Okay. So let's say someone take a loan of 900, right? And then, so this individual, what this individual can do, so either take out the loan, meaning they have cash of 900, or so this individual is going to open an account in the same bank, and then so the bank is going to grant this individual of $900 in his or her account. So in either case, you can see immediately, so there's additional $900 in our economy, right? So there's original 1,000 that belongs to Silas, and then there's another 900 belongs to whoever just take a loan from the bank, right? So now you can see the money aggregate belongs 1,000 plus 900. Okay, let's just look at the next slides to see. Okay. Start with first stage. So this is Silas keep his shoes under his bed. And then the currency in circulation is 1,000. No bank. Money supply is 1,000. Now in the second stage, Silas deposit cash in the bank. And then, so his cash is going to show up as checkable bank deposit. The bank has cash, and the bank is going to make new loans so that they can make profit. So the bank lend out 900 to Maya, and the rest of 100 stay as a reserve. Okay, not in circulation. So now Maya is going to withdraw the cash in this case, right, to do some transaction. Now let's stop it here, and that just means, so there's $900 in circulation besides 1,000 checkable bank deposit belongs to Silas. Now here, so in the second stage, because the bank make loans, and the fund for those loans coming from Silas saving. So you can see now the bank generates some money supply, right? The money supply the bank generate in this stage is 900, actually it's here. Okay, but actually, so this process won't stop. Why? So look here, Maya, he take a loan, and he withdraw the loan from the bank. And then now, so this 900, what he's going to do? So in this example, he pay to Anne. So maybe, so he owe Anne $900. But then think about what Anne, so she's going to do. if she keep this 900 as cash, but then we are going to stop here, right? But certainly, so Anne also lives in 21st century, and she is going to do the same things as Silas did, meaning so she is going to put $900 in the bank. Now the bank will have 1,000 that belongs to Silas, and also has 900 belongs to Anne. So the total bank deposit will be 1,900. Now the bank has additional 900, and what the bank is going to do? So again, so the bank are not stupid. So the bank want to make profit. The bank will make new loans, but how big the loan the bank can make, that depends on the reserve ratio. So again, so you have a reserve ratio of 10 or 10%. So meaning so the bank can make additional $810 of new loans. So now whoever take a loan from the bank, so he or she is going to withdraw this 810 as Maya did. So and then so in the third stage, so we have 1,900 of deposit plus the new loans that's going to generate some new cash, which is $810. Okay, now in the third stage, you can see we have 2,710. Compared to the second stage, the difference lies in here. So the first stage, a difference is here. Second stage, difference here. Or in other words, the bank generates money supply through making loans. All right, so that is the key. Now, to summarize how much money the banking system can generate. Okay, so this is going to be summarized by this equation. Okay, now let me explain to you what this means. So this 1,000 in the example corresponds to the deposit belongs to Silas. And then in the second term, RR stands for reserve ratio. 1 minus RR stands for the percentage of the deposit the bank can use to make new loans. And then in our example, this is like 90%. 90% times 1,000 equal to $900. So this $900 is the first loan the bank made. And who took the loan? In the example, Maya. Maya take a loan of 900, right? And he took the loan and withdraw the cash with 900. So then the money supply increased from 1,000 to 1,000 plus 900. But with this 900, what he did, he actually paid off the debt he owns to Anne, right? And then now, so Anne will have $900. What Anne will do, she will do the same things as Silas did. And she will put $900 into the bank. And then bank has additional $900 of deposit. So with those $900, the bank can make new loans. That goes to the third term, right? So 1,000 times 1 minus RR. So that is the amount of new deposit and just made. And then so we multiply by another 1 minus RR. So that is the new loan the bank can make based on the deposit and just made. All right, so in the example, this is $810. And this process will keep moving, like the multiplier we discussed earlier. And towards the end, you can see the bank will help the economy to generate this amount of money supply, 1,000 divided by RR. And from here you can see the larger the RR, the smaller the money supply. The smaller the reserve ratio, the larger the money supply. All right, let's say, for example, if RR equal to 1, and then this goes to 1,000, meaning so the bank can generate any additional money supply. On the other hand, if reserve ratio goes to 0, and then this goes to infinity, meaning so the bank has the ability to generate as many money supply as it wish, right? But then certainly from this discussion, you can see the smaller the reserve ratio, the higher the risk, right? Why is that? It's because the smaller the reserve ratio, and then the more loan we are going to make. But at the same time, the higher liability the bank will incur. So what happens if or a large fraction of those individuals want to withdraw the cash, and then the bank will face the trouble, right? That also explains so why there's a regulation regarding to the practice of the bank. So that's the previous slides we just skipped. But let's just first look at this practice question, and then we go to the slides we just skipped. Okay. So given this T account on the top, and assuming the bank holds no excess reserve, what is the required reserve ratio? So here, the assumption just says the bank just hold the exactly amount of required reserve ratio. Okay, and then it lend out all of their money. Okay, so now let's see what happened. So in this case, the bank has $1,000 of liability. This show up as deposit. The required reserve is 100, right? And then so the bank make a loan of 400, and they also have some treasury bill of 800. Now the question asks you what is the required reserve ratio, and then the required reserve ratio will be 100 divided by 1,000. Okay, so 100 divided by 1,000 equal to 10%. Okay, so this is this practice question. Let's look at another practice question. Suppose the required reserve ratio initially is 10% and increase to 20%. Holding everything else constant, this will A, reduce the size of money supply. That's true, because the money supply equal to what? Equal to the initial deposit divided by reserve ratio. The larger the reserve ratio, the lower the money supply. B, cause the banking system to contract the level of banking deposit in the banking system. So actually it is also true, right? So essentially that's just going to curtail the bank's ability to make new loans throughout the process we just discussed. C, change the value of money multiplier from 10 to 5. So the money multiplier equal to 1 over RR, right? And then it's going to change from 1 over 0.1 to 1 over 0.2. So this is 10, this is 5. Okay, so hence the answer is D. Okay, so now let's go back to the slides we just missed. Okay, here we are. Okay, so to summarize again, so just repeat what we just learned earlier. The primary purpose of financial market and institutions is to act as a bridge between lenders and borrowers. But then, so by accepting deposit and making loans, banks and other financial institutions are also able to create money. Like in the example we just showed, Silas put money in the bank, and the bank make loans based on Silas' money. And first, the money goes to I forgot his name. It goes to the first person. The first person withdraws the money, withdraw the cash, and then so you can see immediately credit money. And this process keep going, so you can see so the bank or the financial institutions creates lots of money, right? Okay, the financial institutions operate as part of a fractional reserve banking system. How we understand that? When you deposit money in a bank account, the bank is required to hold a part of it in its vault as cash. And then the rest of your deposit will go to the process of making new loans, or will go in the process of creating money. So in that sense, it is a fractional reserve bank system, right? But then the reserve, the smaller the reserve, and then it's going to make the depositors or the savers more nervous. Just think about the extreme example. If the reserve ratio is 0, meaning you deposit your money in the bank, you know there's nothing in their vault as cash. Meaning if you want to withdraw cash, nothing they can do. Right? This is where does nervousness coming from. And in the extreme case, or in reality, what happens is, so the bank can't satisfy the demand of withdrawal, and this bad news will spread as rumors. The more depositor will come to the bank, and then so it's just going to make the problem worse and worse. So this is what we call the bank run. So this is a phenomenon in which many of the bank's depositors try to withdraw their fund because they fear a bank failure. Right? To avoid this bank run, okay, those are just historical episodes. To avoid the bank run, so the central bank had several regulations. Okay, so there are 4 types of regulations. First is called deposit insurance. Okay, so this deposit insurance is a guarantee that the bank's depositors will be paid in case the bank fails. Okay, and the law regulates each bank must insure the first $250 of each account. What that means is if you have a bank account, you deposit your money in the bank, and by law, the bank is required to buy insurance to guarantee your first $250,000 will be safe in case the bank fails. Okay, just think about if the bank fails, who is going to be responsible for the money, or who is going to be responsible for your deposit? So actually, it's the insurer, and who is insured in the United States is called Federal Deposit Insurance Corporation. This is a government agency or the government-backed corporation, right? Okay, so this is first regulation. The second regulation is capital requirement. So what is capital requirement? It just requires the owners of bank, they also hold substantial more assets than the value of bank deposit. How to understand that? So in the example we just showed, the bank or the money coming from the savers, the bank is going to operate the savers' money. So they may not have enough incentive to keep your money safe. Because in the worst case scenario, the bank failed, so they didn't lose anything. And to give the bank or the owner of the bank incentive to watch the savers' money, this regulation requires the owners also put a significant amount of their own money into the bank. So that is going to give them incentive to keep their practice safe, right? Okay, so for today, I'm going to stop here. And next class, we will pick up from this banking regulation to understand how this bank regulation can avoid bank run. But certainly, so that all coming from the process we just discussed. So the financial system can create money, but certainly it's also generate some risk. Okay, thank you, and see you next class.